Welcome to Accounting 2's first lesson. This is asset gain and loss, and it's not going to be a super long lesson. Parts of it you've already seen in other lessons. So as I said in Accounting 1, only about 8% of corporations have this, and most of them are very large. Not really in the Halon kind of situation. So you're not going to see a lot of asset gain loss. Most assets are just thrown out. And while it does constitute a sale, it is not a taxable event when you throw out something that's worthless and you had fully depreciated it. Does that make sense? And clients very rarely tell us when they do that anyways. So as a kind of an operational idea, asset gain loss, you're going to know it when you see it. In addition, most assets under $2,500 are just expensed, so they're not capitalized. So again, it's really just going to apply to larger assets that are sold for some kind of money or other value. And you know how many clients you have that are doing this kind of thing, and that should give you some idea of where you're going to see this. Nonetheless, we need to know how it works, and I'm going to kind of jump in here and start with the different types of property that we have, because there's different rules that apply to different types of property. So this very bright green slide is where we're going to start and kind of get to know that there are several types of property as it relates to gains and losses when businesses sell property. The two that we are going to be seeing the most is 1245 and 1250 property, but I want you to kind of be aware of all of them. First is a 1245 property. This is tangible property. This is all the stuff that businesses use. This is equipment, office supplies, desks, etc. This is the very common category, but very rarely sold off. If you use a desk, I mean, maybe people do sell a desk. They sell it for very little compared to what they bought it for, and many other things like staplers and other stuff, that's probably thrown out whenever it doesn't work anymore. Many times these assets are used until they are worthless. Next is the 1250 property, and why we still allow real estate to be depreciated is kind of beyond me. 1250 property is depreciable real property. It's real estate. And since we do allow depreciation, we have to kind of treat it differently. Now, the reason I say I don't know why we let people depreciate this stuff is because very rarely, I know in the crisis we saw real estate lose value, but very rarely does it lose value because it intrinsically depreciates. And so what we end up with is we depreciate it kind of in a false sense of expensing, and then I'm gonna show you how we kind of recapture that. But anyways, it doesn't matter because it is what it is. 1250 property is the real estate, and there's a few interesting things that are built into it, but you're going to see some of this because you're going to have clients that are buying commercial buildings or using real estate for business, and this is going to be on your radar screen at some points. Not hugely common. I mean, maybe out of 400 clients a year, I may see 2 or 3 of them have some kind of commercial property transaction. Now, the other 3 categories are the much less used stuff. First is the 1252 property. This is short-term farmland, meaning owned less than 10 years, and you have to have deductions for soil or water conservation against it. Again, I don't have any clients with this, but if you do, it's something you'll want to take a look at. 1254 property is drilling costs that get capitalized. So some states have more of this than others, right? Like if you live in a state where there's a lot of people drilling, you may know what 1254 property is. It is the exploration costs and how you recoup those costs in a sale, because you have to capitalize what you're spending as you're drilling wells, that kind of thing. And then 1255 is really weird stuff, like you see this in timber timber operations, there's like agriculture incentives that when you're running land like that the Department of Agriculture, I think, gives you incentives or credits that you have to capitalize, and then when you sell the wood, you have to somehow factor those incentives into the gain. I'm telling you, never ever seen anything like that. But these are the five types. Our lesson is going to focus on 1245 and 1250, as that's what you're going to see with Halon clients, and that is definitely the most common. If you run into the other types, we can do it. We can do it at Halon, but as you know, with many things, whenever it's weird or different, it's going to be an upgraded return. So we're going to upgrade that return to assisted. Okay? Let me start with 1245 property here. So 1245 property, definitely common. Sometimes you're going to hear people also call it 1231 property, but technically there's no such thing. 1231 properties usually considered to be 1245 and 1250 property because both of them can have section 1231 gains attached to it. But if you look in the code, there's no actual 1231 property. It's more of an umbrella term that they use for 1245 and 1250 property. So get in your mind, try and not think of things as 1231 property. Try and think of things as 1245 or 1250. Okay, they can both throw off these 1231 gains, but I'm going to get to that here in just a second. First, know that any tangible personal property item is 1245 property. And when we sell it, we have to calculate a gain or loss. Now, let's say that I fully depreciate my desk and I never sold it. Rather, I threw it in the trash. Is that a sale? Have I sold it? Yes, that is a disposition. We sold it for $0. However, is there any gain on it? No. Because I'd fully depreciated it, and the sales price were both the same. Most property, as I said at the beginning, goes this way. It's trashed when it's all used up. And as an example of something where we do have to calculate these things, let's think about a new asset rather than the desk. Let's think about a forklift. Maybe somebody buys a forklift for like $10,000, depreciates it with bonus depreciation, then sells it 3 years later for $3,500. Now, that bonus depreciation, they depreciated the entire thing, so the basis was $0 when they sold it. Is that a gain? Yes, because it had $0 basis, and we sold it for $3,500. So I'm going to show you some examples of how this works in the next slide. And we'll start by getting kind of an understanding of what the two types of gains are that we can have with 1245 property. So we're going to do several examples. The first one illustrates kind of a very typical situation if there is any gain at all. The typical situation is there isn't anything going on because they disposed of an asset that was worthless. But in this example, here we can see the sales price. The sales price is $3,500, and then the cost basis and the depreciation. The main thing is to always keep in mind when you're recapturing depreciation, meaning you sold it for more than what the depreciable basis was, that's going to be an ordinary gain, taxable at regular tax rates. So let me show you what's going on here. So, and I'll grab my highlighter. We'll highlight some stuff here with the laser pointer. Here we go. So the sales price was $3,500, but we originally bought it for $10,000, and the depreciation that we took on it was $10,000. So the basis is $0. Now, when I sell this, because the basis was $0, that is going to be ordinary gain. Okay? And that's because we're recapturing depreciation that we took. Technically, if it was still worth $3,500, we shouldn't have been able to, in kind of common sense terms, depreciated it down to $0. That's why we have to claim ordinary gain. Now, this ordinary gain goes on the 1120S, goes on the first page of the 1120S. So this is taxable as kind of a regular income item. However, the 1231 gain is $0, and I'm going to show you another example here in the next slide where we do have section 1231 gain, but I'll tell you what that's from. 1231 gain is almost like capital gain. You have to think of it like if we would have sold it for more than we bought it in the first place. That's what 1231 gain is going to look like. In this next scenario I'm going to show you, it's a little easier to understand. So let me move forward on that one. Okay, so here is a different scenario. Let's say it's still a forklift if you want to, and we purchased it for $15,000. Now, this is the same example from accounting 1 that I gave. You've seen this example before. You can see that the depreciation that I took was only $2,000 in this example, right? And so the adjusted basis is $13,000. Well, the sales price is $25,000. We have to recapture the depreciation as ordinary gain. Okay, so $2,000. This matches the depreciation here. So ordinary gain can be considered, what the sales price is in relation to the adjusted basis, but no more than what the original cost basis was. Then the 1231 gain is the difference between the 25 and the 15 here. That goes over this 1231 gain, and you've seen this before from the Schedule K lesson. This goes over to the Schedule K and is taxed differently. This gain is treated more like capital gain, and that's all done on the personal tax return. Our job in doing the corporate tax return is just to make sure this ends up in the right bucket. Now, as I said before, in the Accounting 1 module, how often really do you sell a desk or a forklift or a stapler or any of that for more than you purchased it for? Not often, right? So 1231 gains, at least in my world, are very rare. But 1231 losses are not. So let me show you an example where you may have one of those. Okay, so same property as we had just in the example before, only this time instead of selling it for $25,000, we're going to sell it for $5,000. Now this is much more typical, right? If you bought a forklift for $15,000 then later sell it for $5,000. Okay, so now we have a loss because we sold it for $5,000. The adjusted basis is $13,000. So gains get split out. And losses go to 1231 losses. Here's kind of the funny thing. 1231 losses are still ordinary losses. So that's why there's no breakout. So 1231 gains are treated like capital gains, so they get the lower tax rate, but the losses can go against ordinary income. That's really good for the taxpayer. So if let me say that again. If you have a 1231 gains, those are treated like capital gains, but 1231 losses are ordinary losses or have a character of ordinary income. They can go against ordinary income as ordinary losses. So the code's on our side there. Here, again, and let me get my laser pointer back out here. The adjusted basis was 13 and we sold it for 5. No ordinary losses here. Just 1231 losses because both are the same. I could have moved this to ordinary losses, even though that wouldn't be right. This needs to still be reported on the Schedule K as 1231 loss. But they're treated the same way. So when something's losing money, just know that if their basis is still 13 and they sell it for 5, they're going to get to deduct that difference, that $8,000 difference as a loss. Okay, and if they ended up making money as a 1231 gain, it's capital gain, so they get preferential treatment. It's kind of cool, I think. Okay, so that's 1245 property. Let's jump into 1250 property. Because with 1250 property, now we're dealing with real estate. We still end up splitting the gain between what was depreciation recapture and what is capital gain. Only now the depreciation recapture is called unrecaptured 1250 gain and goes on the Schedule K. This is because unrecaptured 1250 gain has a max tax rate of 25%. So when we have something different, right, and a rate, something weird that can't just go on the 1120S, we have to put it on the Schedule K. And that way the 1040 kind of knows how to treat it. Besides the unrecaptured 1250 gain, the other amount is capital gain, tax at capital gain rates. This is actually 1231 gain, same thing as the 1245 property, capital gain rates, etc. So in this example, we have a sales price of $500,000. We're selling property now. Originally, we purchased it for $400,000. So that is a $100,000 capital gain, right? That's where that $100,000 capital gain comes from, purchase price versus sales price. We also had depreciated the property $40,000. So that has to be recaptured. And that's how we calculate the unrecaptured 1250 amount. In a loss situation, where the basis exceeds the sales price, like in the previous example, it's all ordinary loss. So kind of consistent. When you lose money, you get to kind of take it as ordinary loss. When you make money, part of it may end up being able to be capital gain, the part that's above and beyond what you originally purchased it for. The recapture, even in this case, the recapture of the 1250, that's at maximum, up to a max of 25%. So if your ordinary income, if you were in a tax rate on your personal tax return of like 40%, that's still better. It's better to have taken the depreciation than taken the unrecaptured 1250 on the way back out, because you got a preferential tax rate on the way out. So also, just a little note, keep in mind that all of this only applies to property that has been held for more than 1 year. Okay, so long term. If the property has not been held for at least 12 months, then all of this is ordinary gain and loss. It's just all of it's ordinary, as most short-term assets are. So 1250 property, not really that tricky, and kind of a similar to the 1245 property. And these are the two you're going to see now here. And I've got another slide on this. Don't get too wrapped up in all of these things. I'm going to show you the 4797 form next, but Halon does all of this for you. All you really have to tell Halon is what was sold. Click on the asset that was sold, tell us what the sales price was and the date of the sale. And Halon's going to do the rest of this for you, right? So this isn't some kind of thing where you're going to be manually calculating this on your own, but it's important to know the details and to understand where this stuff all comes from. All right, let me show you the 4797 a little bit. Okay, so I have mocked up a few different forms here. I've got them in PDF format. You should be able to see my screen here. And as I said in Accounting 1, when it comes to the 4797, it's 2 pages. We actually have to look at the last page, the second page, to kind of understand what's going on this first page. So I'm going to scroll down a little bit here, and this is the second page. Okay, and I have simulated 2 different pieces of property being sold and kind of what they'll look like on the 4797. The first one is desk 3, whatever desk 3 is, and then property B is a building. And we can see that one of them was purchased in 2012, at the beginning of 2012, one at the beginning of 2013, and then they were sold at different times during 2017. Let's look at the desk first, which is property A. So the gross sales price of the desk was $85,000, and the cost basis, the original cost basis, was $70,200. So what do we know right away? We know right away here, let me make sure that my pointer here is working. Okay, yep, you can see it. So what do we know right away? $85,000 is more than $70,200, right? So we know that we're going to have a 1231 gain here because we know a desk is 1245 property. We can also see that depreciation of $39,595 was taken against the desk, meaning it has a basis of $30,605. The total gain is the difference between this 85 and the 30. That's the total gain. We know that gain is going to be split between 2 different kinds of gains, and that starts to happen right here in this next section. If 1245 property, how much of it was depreciation? Now, if I scroll down, I'm going to see some of the totals down here, but before I go to the first page and show you where this thing really breaks down, let me show you property B, which is the building. Here, it's a similar situation that we had before. So we've got a $500,000 sales price, an original cost of $400,000, and then depreciation of $47,007, and an adjusted basis here of $352 on this building, and then we've got total gain. It's 1250 property, right? So if section 1250 property, that's that next section right here. If straight line depreciation was used, enter 0 on 26G, which is right here, and then move on to the first page is what it's saying. And just so you know, most property, I want to say after 1987, is supposed to be depreciated on the straight line basis. If you had a property that was from 50 years ago, this calculation could be a little bit different, because if it was using accelerated depreciation, you may have an ordinary gain situation to recapture the difference between straight line and the accelerated depreciation. But for now, don't worry about that. Just know that here's the two situations. We enter a 0 for the 1250 property, and now I want to take you over to the first page. So we're going to come back to the first page of it, because here you can see total gains were 201, and then it's breaking out the depreciation piece here. But let me show you 4797, page 1. Here, what we can see is what's ordinary gains versus capital gains. So let me zoom in here a little bit so we can see this. Here is all of our, what I would call non-ordinary gains, because I'm going to show you something that's kind of confusing about the 4797 after I say all of this. Here's all of the non-ordinary gains, whereas this is the ordinary gains. This is the depreciation recapture we had on that 1245 desk. Okay, that 39,595. And then here's the rest of the gain. Now the question becomes, how come the 4797 doesn't break out unrecaptured 1250 gain, section 1231 gain, and all of that? I don't know. It should, frankly. I don't know why it doesn't make the breakout here, but it doesn't. Instead, and I've got some other attachments here, you actually have to go all the way to the K1. And the K1 is where it gets broken out. You can see here that here, let me zoom in on this a little bit. Here is the unrecaptured 1250 gain. Remember, we had some depreciation on that building that needed to become unrecaptured section 1250 gain. And because this person owns 50%, they get 50% of that, and the other shareholder gets the other 50%. Notice something about this net section 1231 gain. It's 80,904. Well, if I come back here, this is 161. So half of this whole gain is showing up here on this K1. Look at this. Showing up here on this K1. Well, aren't we double counting then? Because part of this 1250 gain is in here. Why wouldn't this be whatever the 1231 gain is less the 1250 gain? That's another little confusing thing about these, is it's not. You report the total 1231 gain here, and then it's almost like the unrecaptured section 1250 gain is a breakout, saying of the 1231 gain, here's how much of it is 1250 gain. And that's tricky. You don't have to worry about it. Halon's going to create all of this for you and send the K1s, but I just want you to kind of know how some of the details work out. And if anybody ever asked you that, now you can kind of refer back to this lesson and say, that's how that works. Now, the ordinary gain, which was created from the desk, the 1245 property that had depreciation on it, we were recapturing that it was actually reported on the 1120S on the first page and is buried in this ordinary income piece, because it was income and then it had all the deductions and whatever was left over became ordinary income. So that's buried in here, whereas the 1231 gains and the breakout of the 1250s both right here. So does that make sense? I mean, it's a little tricky. And again, you know, Halon's going to do all this stuff for you, but just know that, come back to this video if you need to, if you ever have a situation like this, and you'll say to yourself, I see how that's all working out. Okay? So that is the 4797 and kind of how it interacts with the K1s. Now we're almost done. Let me show you a journal entry, because I think, whenever you sell an asset, what does a journal entry look like? So here's a journal entry. I found this online somewhere and was a good example of how to book an entry whenever you sell something. Whenever I'm doing a journal entry and getting rid of an asset on the books, and Halon wants you to do it this way because Halon can read all of this, I tend to start with what I know, right? I tend to start with what I know and then kind of solve for what I don't know. And what I know to start off with is I need to credit the vehicle out of there. So right here, in this example, the vehicle originally cost $19,500. So I know I need to create and that was a debit, right? Because we're increasing an asset whenever we originally bought the car. So when we're selling it, I need to get it out of there. So I'm going to credit the cost of the vehicle here, and then I'm going to debit all of the accumulated depreciation I had on the balance sheet, because that needs to get out of here too because we're selling the car. I also know that we got $7,500 cash for the car, right? So I'm going to debit that because I'm increasing cash. Now all I have to do is solve for what the gain or loss on the disposal of the asset is. And because I was, before I had this, I was short in my debit column, that is what the gain loss amount is right there. And Halon's going to see that. Halon's going to see how you've booked that and is going to make adjustments based on that. Now, let's say that you didn't have any depreciation in your books, and you, in fact, to get rid of the asset, you were just crediting, the vehicle, and you had this huge number on this income side. You'd have the cash here, but this gain, it would probably be a gain at that point a loss. It would just be a much larger loss because you weren't showing any depreciation. That's okay. You can do it that way. Halon's still going to read it and then do its own calculation. When I say Halon reads it, it just reads it enough to say, okay, I see that all of this is in here, and now I'm going to compare that to what I think it is. And Halon, of course, knows what the depreciation is. It knows what you sold the vehicle for because you're going to type all that in, and it's going to do this calculation correctly. One of the cool things we're working on is if we could ever get to a point where the financials were so consistent in having the correct depreciation and everything, could Halon read this and just use it? We're probably a long ways off from that because not everybody books accumulated depreciation into their financials, and we have to be able to do it both ways. But this is the typical journal entry for disposing of an asset. So I thought it would be good for us to cover that a little bit. And now we're done. So like I said, not too long, but here's the action plan. So 1245 property and 1250 property, those are going to be the two categories you see the most. Okay, those are going to be the ones that are most common, so have them fresh in your mind. If this video didn't totally make sense, watch it again. 1245 property, remember, is the tangible property. It's the tangible personal property, and has gain. If there's a gain, it is split out between ordinary and 1231 gain. 1250 property, which is real estate, has gain split out as unrecaptured 1250 gain and 1231 gain. 4797, Form 4797 summarizes it all, right, for us, and then moves parts of it to the 1120S and to the K1. Finally, I showed you how to book the asset sales and use that journal entry if you want to as a template for how to do that, and you should be fine. If at any point you have a question or something you're not quite sure how to do, that's when you open up the chat on Halon in the Halon tax software. Get a hold of support. We can have one of the CPA tax team members kind of walk you through all of this stuff. You know what I mean? So we're here to help you, and we're here to back you up on all of that. That is our first lesson in accounting 2. So that wasn't too bad, right? I've got some more for you. So if you have the stamina for it and you haven't been watching these all day, I'll see you over in the next lesson, and we'll keep this train moving. I'll see you then.